Hi and welcome to this month's Trade Floor Update. Today I'm joined by Portfolio Manager Aditya Thacker. AT, let's start with the RBA. They did cut by 25 basis points this month. What drove their thinking and what are our expectations for further easing this year?
Yeah, the RBA cut by 25 basis points, as you said, to 3.85%. But yet again, they surprised the market. So if we cast our minds back to February when they cut, which was also broadly expected, they were very hawkish. They didn't pre-commit to any further easing. But this time around, they very clearly signalled that the journey to neutral has now begun. So what kind of changed in the last couple of months? Well, in aggregate, the data just forced them to downgrade their forecasts. So when we look at their year-end forecasts for trim mean inflation, that was lowered by 10 basis points to 2.6%, pretty much at target. When you look at unemployment, that was increased by 10 basis points to 4.3%, which is getting very close to the estimates of NAIRU. So that's saying a labour market that's much closer to being in balance. And growth was downgraded by 30 basis points to 2.1%, which is around their estimate, perhaps a little bit lower than potential growth. So you've now got inflation on a clear path to target, as the first chart shows. You have softer growth environment, and given the global backdrop with policy uncertainty and trade wars, you've got increased downside risks. So that really laid the foundations for a 25 basis point cut. But the RBA actually considered a 50 basis point cut. That's the most dovish element of this meeting. And it really tells you that their hurdle for further easing is pretty low now. So where are they going to get to? Well, we think that a neutral cash rate in Australia is somewhere between 2.5% to 3%, so call it 2.75% as a midpoint. So we're expecting at least another 3 to 4 25 basis point cuts at a quarterly pace, and we would say that the risk to that is very much skewed to a faster pace and perhaps deeper cuts should some of those global recession risks start to materialise.
Okay, let's transition globally now. Policy uncertainty in the US this year has been pretty elevated. That's translated to a lot of volatility across a lot of asset classes, especially in recent times. And it's also brought into question many people questioning the end of the US exceptionalism thematic that has really driven markets over the last 2 years. What's our thoughts on this and how are we positioning portfolios as a result?
Yeah, I think when you think about US exceptionalism, and by which I mean the outperformance of US growth and productivity relative to other countries, I think there are certain serious question marks, whether you're looking at it from a cyclical horizon, like in the near term, or even a secular horizon over the medium term. Let's just take cyclically. You've obviously got a big tariff shock, which is going to be a supply shock to the economy. You've got a very elevated policy uncertainty, which the second chart shows. And now you've got question marks around fiscal policy and the hit to sentiment from wider fiscal deficits in the US. So all of that has caused us and other forecasters to downgrade their growth expectations for the US. We now expect growth in the US to be somewhere between 50 basis points to 1% for this calendar year. That's down from the low twos. And that's really getting into that dangerous stall speed area. And when you think about over a longer horizon, over a secular horizon, the changes that are being proposed in terms of immigration policy, which will obviously affect population growth, the potential for reduced spending or funding on education, on health services, on medical research, all of these things are going to potentially impact the inputs to potential growth and really the foundations, attack the kind of foundations of innovation that have distinguished the US from other countries. So from that perspective, we do have to take these risks seriously, and we do think that there is some additional risk premium that global investors will expect for this additional uncertainty. So from a positioning perspective, when we think about our risk factor approach to positioning, this is why we have a much more diversified exposure to our duration exposures. We're long duration in other countries, particularly Australia, the UK, countries which would have a disinflationary impact from the current trade wars. When we think about yield curve shape, we have a bias for yield curve steepness, which should benefit, given that fiscal policy around the world is going to rebuild this term premia into long end of interest rate curves. From a spread perspective, we're going up in quality, and we have a preference for securitized assets, where we're a bit closer to the underlying cash flows of the assets as opposed to generic corporate credit. And in terms of FX, we now have a short US dollar bias, primarily expressed against a defensive basket of euro and yen crosses. The last point I would make is that, should some of these risks materialise, Australia is probably one country that would really benefit, just given that the political situation here is fairly stable. We've got good rule of law, good transparency in governance. These are all the things that would attract capital and be beneficial in terms of capital flows for Australia.
Thanks, AT. Really appreciate your insights. With attractive starting yields of 6 to 7% for high quality fixed income, we really believe in its opportune time for investors to lean into fixed income in terms of their portfolio construction, to not only generate attractive and resilient income streams in the face of declining cash rates, but to hedge against potential elevated levels of volatility going forward. If you have any questions or would like further information, please reach out to your PIMCO account manager.